Welcome to this video on micro-alphas. The efficient market hypothesis states that all information available to the market is contained in the current price. In other words, price movements are random and unpredictable. As a consequence, it would be impossible to consistently generate profits. This very academic view is a good baseline for further assumptions, but it is easily overturned by looking at the performances of some of the most successful hedge funds in history. If you take Jim Simon's Medallion fund for example, there is less than a 1 in a quadrillion probability that their performance could have been achieved by chance. This is perhaps the most extreme example, but there are many others. In reverse, if markets were truly efficient, there would be a diminishingly small probability of seeing managers and funds that consistently outperformed the market, year over year for decades. In essence, this tells us that there exist ways to exploit these inefficiencies, but it takes technical expertise and creativity to find them. In order to establish a baseline, let's start with creating a series of stock returns at random. Plotting a histogram of a sufficiently large number of these returns, we can see that it has the characteristic bell shape of a normal distribution. Next, we generate a series of 750 trading days, approximately 3 years, with a starting price of 100. It is easy to see that a skilled technical analyst could fill this chart with trend channels, resistance lines, breakouts, and head and shoulders patterns. However, the progression of prices is purely random, and nothing in the world will be able to generate a reliable prediction for the movements. You can show random and real charts to seasoned traders, and yet never come across groups of even the most experienced traders consistently picking the true charts. One of the properties of completely random charts is that they lack any kind of autocorrelation, that is, correlation of current return with returns end periods in the past. Let's test this for our current series. Clearly, there is no correlation between current and past or lagged returns. On the other hand, if a trader wants to use technical indicators, he implicitly assumes autocorrelation in the series. One of the most popular technical indicators is the moving average cross. It looks for the difference of two moving average lines to establish a trend, an uptrend if the slower line is below the faster line, and vice versa. We can see that the layering of the indicators tells us something about the trend direction. However, if you actually test this, you will find that if you tried to trade random series like this, you will not be consistently profitable. In fact, what looks like a trend in this chart are not real trends. There is a difference in prices moving in a direction and a real trend.